Hi everyone, this is Jonathan Cameron, Certified Financial Planner at CameronDowning. In a previous video, I gave a brief overview of the Roth IRA. Here I want to dive into the topic of Roth conversions. Before I talked about some of the rules you need to know in order to contribute to a Roth. The IRS begins to phase you out from doing contributions if, as a single taxpayer, your adjusted gross income is over $116,000 or over $183,000 if married filing jointly. Even at that, the contribution limit is only $5,500 per year or $6,500 if you're over 50. So let's say you earn more than these phase-out limits. What can you do to still get a tax-free income from a Roth IRA? The answer is that you can convert your traditional IRA into a Roth without any limits. When you do a conversion, the amounts converted are fully taxable to you at ordinary income rates in the year you convert. The trade-off is taxation now in exchange for a tax-free stream of income that could last for years in retirement. There are ways to spread out what you owe in taxes. You may want to convert a little at a time. Here's a story to give you an example. We have one client who unfortunately became disabled. He has a sufficient tax-free income from his disability policies. We're now converting his traditional IRAs to a Roth. We'll do this over years, a little bit at a time, so we're keeping him in low tax brackets. The result is that by the time he turns 65 and the disability income runs out, he will have additional tax-free income from the converted Roth IRA assets to last him the rest of his life. This is really good tax planning. Here's an important point you need to know when considering a Roth conversion. When you convert, you've got to do it proportionally across all your IRA assets. Here's what I mean. Say you have 4 different IRA accounts and each one has $250,000 in it for a total of $1 million. You want to convert $250,000 this year. You cannot convert just one account. You have to take 25% of each account to keep it proportional. Once you've converted, there are some tax caveats. There is a 5-year holding rule to be aware of, among others. Now, we're going a little deep in the weeds here, so stay with me. On converted assets, you can take those converted dollars out of your Roth IRA with no tax on the withdrawal, if it has been 5 years since the conversion. You would pay a 10% penalty on that amount if you're less than 59.5 and you failed the 5-year holding period. Taxation on earnings distribution is another story. Again, if you fail to meet the 5-year earnings test, those earnings will be taxed at ordinary income rates, and you would also have a 10% penalty tax penalty if you're younger than 59.5. Now let's really get into it and talk a little bit more about strategy. Let's say you've converted your money in February. You converted a traditional IRA of $50,000 into a Roth. You're at a 25% marginal bracket, so you paid taxes of $12,500 at the conversion. Later in the year, the market went down and your portfolio value dropped significantly. That means that you paid taxes on a higher conversion value than the account is worth today. Do you have a remedy? The answer is yes. You can recharacterize or reverse the conversion. You can essentially hit the undo button. You have until the next filing date, plus extensions, to do so, which would ordinarily be October 15th. So there is a safety valve there on conversions if the market subsequently tanks. Here's another good strategy. If you created one Roth IRA, the market drops, and you wanted to reconvert or recharacterize, you can't just cherry pick positions you want to undo. You'd have to undo the conversion of each asset as a consistent percentage of the account across the board. What you can do in a Roth conversion is mitigate your risk by converting into more than one Roth account. Here's an example. Let's say you want to convert one traditional IRA and spread those dollars across 3 Roth IRAs. So you put your US equities into Roth number 1, then you put fixed income into Roth number 2, and international equities into Roth number 3. Then say you lose money in the Roth with the fixed income. What can you do? Recharacterize just that one Roth account and save taxes on the loser. This is complex stuff, and we're here to walk you through it. I'm Jonathan Cameron, Certified Financial Planner of CameronDowning. Please visit us at CameronDowning.com and connect on LinkedIn, Facebook, and Twitter for more financial information that is relevant to you. We look forward to hearing from you.